Hey, welcome to the Market Investor. I'm Daniel Snyder. Thanks for clicking on this video. I really hope you're interested in what I'm about to talk about. This is a strategy I've been using for a while, and some people call it different things. Some people call it the time decay strategy, but most people just call it a credit spread. So what am I talking about with credit spread? Well, before we get into the credit spread, you'll have to understand what an option is. An option is a different type of security like a stock. But instead of being the actual asset of the stock, it's a contract made between two other people in the market to pretty much guarantee that at the end of the contract, it does have a time constraint. At the end of the contract, you can either buy or sell the underlying asset. Most of the times, I just play the stocks, right? So say Apple's trading at $100, and I say, okay, well, in a month time, I think Apple's going to be trading at $105, but I'll pay you X amount of dollars now. Instead of buying 100 shares of Apple right now, instead of spending all of that money, I'll spend a lower amount of money up front, and then at the end of the month, if Apple's over $105, say it's $110, then I get to buy 100 shares of Apple for $105, and that $5 range in between from what it costs at the market at the end of the month is pure profit for me. But it's all because of the contractual agreement I made with somebody else that they would sell me 100 shares of Apple for $105 at the end of the month if it was above, right? And it gets more detailed, and we'll get more detailed into it. But that's just a very general kind of idea. So it's you having the ability to buy 100 shares of whatever asset. There's other contracts as well, but I'm just using the stocks at the end of a certain amount of time for a set price. So the thing about the credit spread, though, the credit spread is the difference in the yield between two different options. And the great thing about this strategy is that the time decay, which is one of the Greeks, and we'll get into that later as well, but one of the Greeks is the time decay of the contract works in your favor if you are, say, selling the 105 and buying the 100 for a put credit spread. This may scare you a little bit, may sound complicated, but it's really not once you get the hang of it. And we're going to dive in a second. I'm going to show you how today I made $153 with the stock market going down, because yesterday I opened options. I opened two different credit spreads yesterday, predicting that the market would go down. So what I did is I sold a call credit spread. I sold two of them, and I'll show you the difference in them. Actually, I sold multiple contracts, but two different spreads, and that'll make more sense once we get into it. But pretty much when today's trading day finished, those contracts expired worthless, which is great for me, but not for the person that bought or sold the contracts from me. So it's just another way that you can learn to profit even when the stock market goes down, right? Making your money, make you money. That's what we're going to talk about. So without further ado, let's jump into the computer. I want to show you how to open these strategies in the Thinkorswim platform. All right, guys, so we are in the Thinkorswim platform right now. If you haven't seen this before, this is what it looks like. These are watch lists, obviously. So these are kind of where I put my assets that I think I want to either trade or invest in. One that you'll see here at the top, and this is the one we're going to focus on today, is called SPY. And SPY is a highly liquid ETF, exchange trade fund, that follows the overall S&P 500, right? So this is the SPX Index. This is the S&P 500 Index, which I referred to in my last video. The index is just made up of, in this particular one, roughly 500 companies that are all weighted to a certain degree that make up the total value of this index. Now, just as a reminder, you cannot sell stock or buy stock within an index. See this right here? You can't buy or sell stock. But you can sell options, and you can buy options. And we're going to get into this here. But instead of doing it on SPX, we're going to do it for the SPY ETF. And let's go ahead and just look at the chart real quick. So you'll see a couple things here. This blue line is our Fibonacci retracements, and we'll get into that in another video and what those mean. But just to make this easier to see, I'm just going to change this to a simple view. And so here's today. This little area right here, this is, of course, the 6-month 4-hour time chart. If I move us into the 1-day 5-minute time chart, you'll see this is only today, right here. So yesterday, at the end of day, I was looking over my charts and I realized we are in the middle of the dead cat bounce, right? And I mentioned this the other day. We're in a dead cat bounce. This is not the bottom. As of right now, this was the bottom that we hit. This is the 217.75, as you'll see right here. This is our dead cat bounce. So with that prediction in my mind, I knew that yesterday, since we went down, we were more likely to continue to go down today. So what did I do? I sold a call credit spread. So what that means, if we go over to trade, here's your option strategies, and we can click on all, and you can see all option prices on the market. Here's the price of the underlying asset. So obviously right now, at the end of the day, it traded at 246.15. And so right here, you'll see that between these lines is where our stock is. So to make a call credit spread, you have calls on the left side, you have puts on the right side. So all I did is I went, okay, let me double check. I had the 257, 258, and then I had the 263, 264. So what I did is I right clicked, I hit sell. There we go. Hit vertical. And then this opened our credit spread. And all I did is I confirmed and sent, and it went through, and I bought it yesterday. And I'll show you guys how I close this out. So in the mobile app, which is super simple. So let's get into the Thinkorswim app. And you'll see there's my profits for the day, $156. Since I opened it, it was $153. Obviously, I'm going to click on the 2 contracts I had left. There's 3 each, as you can see there. I'm going to click close. I'm going to click buy 3, sell 3. Click through. And in a minute, it'll load. You'll see all the resulting. You'll see they're both down to 1 cent, so it's okay for me to go ahead and close it. $3.90 for the cost of trade to close it out. It's mainly just the commission cost since there's 3 contracts, six contracts in total. Of course, you can go down, look at the risk profile. I don't really look at these, and as well the conditions. Those are for stocks and just different things you can do. So all we're going to do is click through here, order confirmation. You'll see the break-even price, max profit, of course your cost of the trade including commissions. Send your order through, and boom, filled, just like that. Close it out early, filled by 3, and you're done. So now you don't have to have any worries about the rest of the day. All my positions are closed. Profit and loss of the day was $153. And it's really just an easy way to make some money, even if the market is going down. And that's the great thing about credit spreads. I hope I could help give you a little bit of insight into what a credit spread is and a strategy that you can use yourself that doesn't cost a lot of money up front. Of course, it is limited risk and therefore limited reward, but it's still a good strategy. I use it all the time. It's actually one of my go-to strategies, and you can do it whether the market is going down or going up, and you can make hundreds of dollars, if not thousands of dollars, within a 24-hour period. I mean, it truly is remarkable. But that's it for this video. I hope you learned something new. If you have any questions, leave them in the comments below. I hope you hit subscribe. I hope you liked the video. And we'll see you in the next one.